Good evening and welcome to another episode of Night Markets, where each week I'll be giving you my perspective on what's driving the markets, as well as my point of view as a family office professional. My name is Jacobus Brink, the Chief Investment Officer and Head of Investment Research for South Africa for SFO. So this week we saw the first significant broad advance in the market since mid-April as stocks rose, with the Dow Jones Industrial Average, the S&P 500 and the Nasdaq all reaching record intraday highs. However, the big surprise was the small cap Russell 2000 index, which was the significant gainer, achieving a return of 6% and achieving its best week since early November. Value stocks also outperformed their growth counterparts by a significant margin. So before we get into the details around the market, let's just check in with the current situation in the Middle East. On Saturday, the Health Ministry in Gaza reported that an Israeli airstrike resulted in a number of deaths in a designated humanitarian zone. Israel claimed that the attack was directed at senior Hamas officials. Prime Minister Netanyahu also pledged to continue targeting Hamas's leadership, stating that increasing military pressure on the group would improve the likelihood of a hostage deal. This came despite the fact that 3 days of ceasefire negotiations were suspended on Saturday. One of the senior officials of the Islamist group Hamas stated on Sunday that the group has not withdrawn from the ceasefire negotiations in response to the lethal Israeli attacks in Gaza that occurred over the weekend. A member of Hamas's political office also accused President Netanyahu of attempting to impede the efforts of Arab mediators and the United States to negotiate a ceasefire agreement in his statement. He stated that the escalation in assaults by Netanyahu and his government is intended to obstruct efforts to resolve the conflict. We are of the opinion that the escalation in these assaults by Netanyahu and his government is intended to obstruct effort to resolve the conflict, and this will clearly not bode well for the oil price. And then moving to the Americas, in breaking news on Saturday, President Donald Trump was shot in the ear during a campaign rally, an incident that is expected to significantly alter the course of this year's US presidential election, and also raises significant concerns regarding the security measures that have actually been put in place to protect the Republican candidate. If history is anything to go by, the attempt on Trump's life will most likely give him a boost in the election polls. And from a market perspective, we think investors may consider increasing trades that are more closely associated with the likelihood of former President Trump regaining the White House following his survival of the assassination attempt. And moving to some market-specific data, Friday marked the unofficial commencement of the earnings season in the US, as we saw some results from JP Morgan Chase, Wells Fargo, and Citigroup. JP Morgan and Wells Fargo both missed estimates, and the latter also reduced its outlook for the year going forward. This resulted in a decline in the shares of all three of these names at the start of trading. Analysts currently expect that the S&P 500's overall earnings would increase from 5.9% in the first quarter to 9.3% in the second, and this would actually be the highest rate since the first quarter of 2022. And then looking at some macroeconomic data, the Labor Department's Consumer Price Index release on Thursday was probably the most significant factor in the support of the numerous equity benchmarks that we saw during the last week. We saw the first decline in headline prices since the commencement of pandemic lockdowns in May 2020 occur in June, with a 0.1% decrease in the number. Perhaps most encouraging was the core prices, which excludes the food and energy components, increased at a slower pace than the market anticipated, with a 0.1% increase, which was also the slowest we've seen in the last 3 years. Fed President Goolsbee described the data as profoundly encouraging and can be seen as a sign that inflation was on the path to the Fed's annual objective of 2%. The inflation narrative and its implication for the market were arguably, however, complicated by the Producer Price Index data released on Friday. The Producer Price Index typically tends to lead the CPI numbers by a few months. In June, the headline PPI increased by 0.2%, which was higher than anticipated. Additionally, the decrease in May was revised upwards to remain unchanged. Investors did, however, appear to take satisfaction from the core PPI reading, which remained unchanged for the month. This reading excludes food, energy, and trade services. In the aftermath of the inflation report, the yield on the benchmark 10-year Treasury note experienced a significant decline, momentarily reaching its lowest level of 4.16% since the 12th of March, only to end the week slightly higher at 4.18%. And despite the relatively positive inflation data, the tech-heavy Nasdaq ended the week lower by 0.26%, with the S&P 500 and the Dow Jones Industrial Average both rallying by 0.96% and 1.68% respectively. Then moving across to the Eurozone, in the second round of the French parliamentary elections, no party managed to secure an absolute majority of 289 seats, which resulted in an extended period of negotiations to establish a coalition government. 182 seats were secured by the left-wing New Popular Front, with President Emmanuel Macron's ensemble, which scored 168 seats, ending second. The National Rally, which is the hard right party, secured 143 seats. And then on the monetary policy front, in what could influence the pace at which the EU continues to cut rates, insights from Indeed's wage tracker data for June revealed that the annual increase in salaries for the euro area job openings was 4.20%, which is a significant increase from the 3.47% increase recorded in May. And then moving across the channel to the UK, May saw a 0.4% sequential increase in the UK GDP data, following a stagnant April. Infrastructure and home building were the primary drivers of the expansion, as well as an increase in construction output and services. This was the economy's fastest rate of expansion at 0.9% on a rolling 3-month basis since 2022, so it seems like growth in the UK is moving in the right direction. And then just looking at the market performances in local currency terms, the Pan-European Stocks Europe 600 index ended the week 1.45% higher as investors welcomed lower than expected US inflation data. Eurozone sovereign bond yields were also lower across the curve, falling in tandem with the US Treasuries after the US inflation slowed more than expected. And then moving further east, Japanese stocks declined from their record highs that they achieved on Thursday, as there was increased speculation that the Japanese authorities had intervened in the foreign exchange market to support the yen. The speculation was incited by the yen's increase in value relative to the US dollar, and it was also further bolstered by a Nikkei report that the Bank of Japan conducted rate checks with banks on the euro-yen currency cross on Friday, following the yen's rise. The yen's rise is not necessarily a good thing, as the profit outlook for Japan's export-focused industries is adversely affected by a stronger yen, which also increases the cost of Japanese assets for foreign investors. The yield on 10-year Japanese government bonds also eased to approximately 1.05%. This was a 2-week low, as investors started to evaluate the outlook for monetary policy in the wake of the yen's steep rebound. On the macroeconomic front, in May, core machinery orders, which tend to be a leading indicator of capital expenditure in the next 6 to 9 months, unexpectedly decreased for the second consecutive month. It experienced a 3.2% sequential decline following a 2.9% decline in April, primarily as a result of a significant decline in the non-manufacturing sector. And then moving across to China, some recent concerns regarding deflationary pressures were mitigated this week by some robust export data, which resulted in a rise in Chinese stocks. In June, exports surpassed expectations, increasing by 8.6% from the previous year, which is an increase from 7.6% in May. The reason for the increase in overseas demand was mostly due to manufacturers' front-loading of shipments in anticipation of potential tariff increases from numerous trading partners. Despite the positive news we got on the export side, imports experienced an unexpected 2.3% decline in June, which was a significant decrease from the 1.8% increase we saw in May. This was mostly attributed to sluggish domestic demand, which has been a continuous problem in China. Then on the inflation front, in June, China's consumer price index increased by a less than anticipated 0.2% from the previous year. This was a slight decrease from the 0.3% increase we saw in May. Core inflation, which includes the more volatile food and energy components, increased by 0.6%, remaining unchanged from the main number. The producer price index fell 0.8% from a year ago. This is actually its 21st consecutive month of decline. However, it did moderate from a 1.4% decline in May. And then just looking at the market's performance in China, the Shanghai Composite Index rose 0.72%, while the blue chip CSI 300 added 1.2%. And then bringing it back home, locally in what was a pretty quiet week, the most significant economic release was mining and manufacturing production numbers. South Africa's mining production remained constant year over year in May, but decreased by 0.6% in comparison to the April number. Gold and PGMs were substantial negative contributors, while coal and chromium all made positive contributions. Manufacturing production experienced a 0.6% decline year over year and a 3.2% month over month decline, with the iron ore and steel, motor vehicles, and related sectors experiencing substantial declines. Gains in food and beverages were only partially offset by these declines. In general, the mining and manufacturing sectors struggled due to declining production and sales in a variety of critical sectors. So on the back of a relatively positive week globally, the all-share index ended higher by 1.1%, with the industrial sector jumping almost 2%. The rand also ended the week stronger on the back of a weaker US dollar to end at 17.96 against the US dollar, once again closing below the psychological 18 rand level. And then just looking at the week ahead, this week US economic data takes a step back from the limelight, with the only real market moving releases from a macroeconomic point of view being the retail sales data out on Tuesday. There will, however, be a plethora of Fed speakers making appearances during the week, which could influence the volatility in the interest rate market slightly. We will, however, get a number of US earnings reports from the likes of Goldman Sachs, BlackRock, and Netflix, which will be released during the week. The market's main focus will be on the monetary policy and inflation front globally, as the EU and the UK are set to release its latest inflation prints, and the ECB will be making their latest monetary policy announcement on Thursday. Of big interest this week will be China's third plenum, which is considered one of the most significant annual policy meetings of the year, with approximately 400 of China's most senior officials in attendance. In June, President Xi Jinping announced his intention to implement a series of major reforms, and if these reforms actually surpass the current fairly low expectations that the market has and are deemed sufficient to stimulate development, they could potentially elevate sentiment towards the world's second largest economy. And locally, the highlight of the week will be the Monetary Policy Committee meeting, with market participants currently expecting the SARB to keep rates on hold at 8.25% on Thursday. And then, as always, we'd like to end off the episode with an interesting investment idea we discussed during the week. During the week, we chatted a little bit about frontier markets. These would include the likes of Indonesia, Vietnam, and certain African economies. We do believe this is a fairly overlooked part of the larger investment landscape, and we do think there's quite a bit of opportunity there for active investors. Thank you for joining me on another episode of Night Markets. Financial markets close at 5 p.m. Night Markets opens at 6 p.m. Let's start the conversation.